All right, in this explainer, we're going to unpack an institutional investment thesis that sits right at the intersection of AI compute and energy. And believe me, it's a model that completely flips the script on traditional data center economics. So let's get right into it. I want you to just think about this question for a second. We're in this age where AI's hunger for power is just off the charts. It's insatiable. But what if the whole economic model that we use for data centers is just fundamentally broken? What if we could take a massive liability, I'm talking about waste heat, and turn it into a real, legitimate revenue stream? So here's our game plan. Think of this as us running through a due diligence process together. We're going to look at the big market turning point, break down the core innovation here, analyze the actual returns, stress test all the risks, and then finally map out the investment structure and the all-important exit strategy. Look, we're hitting a wall, a really big one. The demand for AI compute is literally doubling every 18 months, but our physical infrastructure, it just can't keep up. And it's this collision, this clash between digital demand and physical limits that creates the massive strategic opportunity we're about to dive into. This slide really puts it all into perspective. On one side, you have the old way, the legacy data center model. It's slow, it's expensive, it's a total cost center. But on the right, you see the new model we're exploring today. And this isn't just some small improvement. No way. This is a complete bypass of the industry's biggest roadblocks, turning that cost center into a nimble, powerful asset engine. So, how does this bypass actually work? Well, it all comes down to a really elegant piece of engineering and financial innovation that we call the compute boiler. And this, right here, is the absolute heart of the thesis. The idea is actually pretty simple, but its implications are profound. Instead of spending a fortune on energy and capital just to blow waste heat out into the atmosphere, we capture it. A compute boiler is basically a super high-density compute node that uses liquid cooling to grab more than 90% of that heat, and then it turns it into industrial-grade hot water. All of a sudden, waste isn't a problem you have to solve, it's a product you can sell. And what's really cool is this model unlocks value from 3 different angles at the same time. First, you've got thermodynamic arbitrage. We practically get rid of cooling costs. This just crushes the power usage effectiveness, or PUE, which is just a measure of how efficient a data center is, from a pretty average 1.35 all the way down to nearly a perfect 1.0. Second, there's policy arbitrage. We're smart about where we deploy, targeting places with powerful green incentives to get our hands on non-dilutive funding. And third, RWA digital capital arbitrage. We tokenize the physical gear as a real-world asset, creating a liquid investment that's easy to trade. And here's what that triple arbitrage adds up to financially. You can see it right here. Traditional data centers are just struggling with their margins. But our model, which basically works like a distributed energy service company, or DESCO, has multiple diverse revenue streams. That huge efficiency gain we talked about, it translates directly into a seriously powerful gross margin of about 58%. Okay, let's get into the good stuff, the numbers. Let's see how this actually performs out in the real world. And as you're about to see, the returns are really compelling, but they're heavily driven by one single factor: location. In this model, geography is finance. So let's use a real-world example, a full-scale 1.2 megawatt industrial module deployed in France. The total upfront capital expenditure, that's all the hardware, the engineering, the installation, comes out to just a little over 28 million euros. But, and this is a big but, that is not the number we really care about. By tapping into that policy arbitrage, we can secure around 9.15 million euros in non-dilutive capital. This comes from French government programs like the ADM Waste Heat Fund and the CIR Research Tax Credit. So what does that do? It brings our effective capital at risk down by more than 30%, to just 19 million euros. And let me tell you, that is a critical move. It dramatically improves every single return metric that comes after it. Okay, how do we finance this? Through a pretty sophisticated blend of capital. The weighted average cost of capital, our WACC, comes out to 10.7%. Now, I want you to just keep that number in your head because the typical internal rate of return, or IRR, for these projects, it's somewhere between 45 and 65%. That absolutely blows past our cost of capital and creates significant value for shareholders. And here's where geography really comes into play. You can see how the returns shift depending on where we are. In Quebec, Canada, you've got super low electricity costs and cash rebates, which means we get our money back in just over 9 months. Crazy fast. In Norway, they have these established district heating networks that guarantee a buyer for our heat, so payback is under a year. And in France, the price for compute is higher, delivering the highest absolute returns, with a payback period just under 19 months. Of course, none of those fantastic returns matter if things aren't stable. So now let's tackle what I know is the #1 concern for any infrastructure investor: risk. This model, I want to be clear, is engineered from the ground up for resilience. First up, deployment risk. I want you to just forget about that 24-month permitting nightmare you get with traditional data centers. Our modular approach means we can do a complete end-to-end deployment in just 12 weeks. 12 weeks from the first site survey to going live. That speed to market is a massive, massive competitive advantage. And we don't just deploy fast, we deploy right. Every single module has to pass our incredibly rigorous point-fire stability test before we hand it over. We literally push the system to its absolute maximum to make sure it delivers that industrial-grade heat at over 90% efficiency. This is how we guarantee asset quality and reliability for our investors and, of course, for heat customers. Now, this slide, this is where you can really see how tough this model is. We put it through the ringer. What if compute revenue just gets cut in half? Well, the project's net cash flow is still a positive 8.5 million euros. You know why? It's because that contracted income we get from selling the heat acts like a revenue floor, protecting the downside. This shows this isn't some speculative digital asset. It's a solid, resilient piece of infrastructure. And that kind of resilience is what's attracting major capital. We're not doing this in a vacuum. The whole DePIN sector is just seeing explosive growth. We're talking billions in market cap, which really validates the momentum behind this infrastructure revolution. So, we've established we have a profitable, resilient asset. The final piece of the puzzle is, how do we structure the investment? We need it to be tax efficient, compliant, and most importantly, liquid, with a clear path to exit. We use what's become a globally standard dual entity structure. It's smart. A local operating company, or OpCo, manages all the physical assets on the ground. This OpCo then pays a licensing fee to a global foundation, which is based in a more tax-efficient place and holds all the intellectual property. Honestly, this is just best practice for optimizing the tax burden on any global infrastructure investment. So, the big question: how do we create liquidity? This is where things get really interesting. We tokenize the ownership of the asset as an RWA, a real-world asset. This gives investors two very clear exit pathways. You can either sell your tokenized equity on a secondary market for quick liquidity, or you can hold it to term and use the hardware buyback clauses. It just offers a level of flexibility you simply do not get in traditional private equity.
And listen, this isn't some niche strategy we just came up with. The biggest research firms in the market are all pointing to the exact same thing. Masari, Binance, CoinDesk, they have all singled out DePIN as a key investment theme for this year, which just confirms its strategic importance.
So, we'll leave you with this one final thought. The game has totally changed. Electricity is no longer just a line item, just a cost center. It's an asset engine. In the new energy order of the AI age, mastering low-cost power and monetizing waste heat isn't just a financial opportunity, it's how you define the future of energy sovereignty.